Assalamualaikum warahmatullahi wabarakatuh. My name is Alia Patricia and our group will explain about evaluating of finance performance for Sarah Mero Estate MHD and our company chosen Padini. For question 1 about Sarah Mero Estate MHD, as you can see here, only current ratio and non-current assets turnover has the green color, which is better than the industrial average, while the others are red. Firstly, we will discuss about current ratio as M or Sarah Mero get 3.8 times better compared to industry average 2.5 times. This shows the company has more liquidity because in every RM1 of current liabilities, company support RM 3.8 while industry average support RM 2.5. It is good, but company should not be too comfortable for having excess cash because it will not using the assets efficiently. Next, move to the inventory turnover. SM got 2.31 times while IA got 4.5 times. This shows the company is a bit slower than the industry average in terms of measures how frequently a company replaces inventory in comparison to its cost of sales. It is also known as overstacking that are not good for the company sales. The company should work better as need to do more frequent inventory audit to investigate the problems. Thirdly, move to average collection period. SM need to took 101.66 days, way longer than IA that took 80 days to collect debt of account receivables. My suggestion for companies, they need to take action of get their credit policy more strictly as their long debtors collection may affect the company of more problems than short of cash. This will raise non-payment or bad debts too. But the company is good in their time interest earned, which is SM 14 times compared to IA 6.6 times. It clearly shows that the company has ability to meet its debt obligations on a periodic basis. My recommendation here today is debt utilization as it best as their debt ratio is high, so they can support to overcome the rate of debts. Maybe because of all the possibilities of problems before make the SM's company net profit margin a bit lower than the industry average. They got 9.43% lower than 10% of IA. Net profit is calculated by deducting all the company expenses from its total revenue. It is a profitability ratio that provides insights into how well a company is able to convert its revenue into profit after deducting all the expenses. A low net profit margins means that a company uses an ineffective cost structure or poor pricing strategies. Lastly, for the return of assets and return of equity, both analysis got the same outcome with lower than the industry average. Return of assets Sarah Mero company is 12.61%, then 50% of industry average, while return of equity is 17.78% compared to 19.23%. A company with a low ROA may find it difficult to find expansion or invest in new opportunities because they are not yet generating enough returns on their existing assets, while a low ROE on a consistent basis may call into questions the company's leadership, strategic decisions, and ability to create value for shareholders. To conclude of Sarah Mero as the MHD company financial performance, they need to take more actions as to make more good outcomes because their performance is not quite good. For example, they can make strategic investments, make a control of costing, do a benchmark at other companies, and many aggressive strategies.
Hello, Assalamualaikum. My name is Putri Sufi Nurhanan. My ID number is SIT22070265. Our group assignment already choose a company which is Padini Holdings Berhad. So I will explain about the background of the company. Padini Holdings Berhad is an investment holding company based in Malaysia that sells shoes, garments, ancillaries product, children's garments, maternity wear, and accessories through its various subsidiaries. The company primarily exports its manufactured goods to the Middle East and Southeast Asia.
Assalamualaikum, my name is Nur Isnalia and I will explain more for question 2. So the company that we choose is Padini Holdings Berhad, and question 2 about trend of revenue, net income, also expenses over the last 3 years for Padini Holdings Berhad. And so the trend of revenue Padini Holdings Berhad demonstrated strong financial performance driven by increased consolidated revenue, highlighting effectiveness, market strategies, and favorable sales mix. The rise in profit before tax reflects commitment to operational efficiency and cost management through streamlined operation and prudent expense reduction. Fluctuation in gross profit margin were influenced by astute promotional strategies and strategic product offerings. And for the net income, it improved gross profit margin indicates adept management of purchase costs, including negotiating favorable terms with suppliers. The increase in net income suggests the company's focus on cost control measures, potentially through reduced production cost and optimize supply chain operation. Meeting market demand and expanding the customer base may have boosted sales and profitability. And for the expenses, trends over 3 years show a decrease in 2021 attributed to changes in operation, store closures, and headcount reduction. In 2022, expenses increased due to significant changes in the company restructuring in the supply chain and a full resumption of business operation. The rest included increase in salaries, rental, utilities, security, and other similar expenses. So here are the diagram that proves for the Padini Holdings Berhad over 3 years. For the blue line in graph, the expenses over 3 years, there is decrease in year 2021 till 2022 and increase in year 2022 until 2023. For the green line, it shows the trend of revenue over 3 years for Padini Holdings Berhad. And for summary, Padini Holdings Berhad success can be attributed to effective cost management, strategic product offerings, and adapting to market changes. The company financial performance reflects a balance between revenue growth and prudent expense control.
Assalamualaikum and hi, my name is Nurul Yasmin binti Khalid, number ID SIT 22070188. Today, I will discuss about the distinction between trend analysis and inter-firm comparison. What is trend analysis? Trend analysis is the process of analyzing a company's financial records to determine market trends or project future trends based on historical performance data. The goal is to make the best judgment possible based on the analysis findings. What is inter-firm comparison? The inter-firm comparison refers to the process of comparing and evaluating different companies in relation to one another. This can include comparing their products or services, financial performance, market position, or any other relevant factors. Inter-firm comparisons can help businesses understand the competitive landscape and make informed decisions about strategy, partnership, and other business activities. There are 4 primary key distinctions between trend analysis and inter-firm comparison. The first one is time perspective. Trend analysis focuses on the historical performance of a single company over time, while inter-firm comparison compares the performance of one company to others at a specific point in time. Number 2, scope of analysis. For trend analysis, the internal focus is to examining how the company's own metrics change over time. For inter-firm comparison, focus on external focus, evaluating how a company compares to others in the industry. Number 3, generation of ideas. Trend analysis provide insights into the company's growth, stability, or decline based on historical data. For inter-firm comparison, they offers insights into the company's competitive position within its industry. Number 4, decision making. Trend analysis helps in strategic planning and identifying areas for improvement or investment based on historical performance. While for in-firm comparison, they assist in understanding how a company stands in relation to its competitors, guiding decisions on competitive strategies.
Ratio analysis is one method that may be used for assessing and analyzing a company's financial status. It enables the stakeholder to understand the company's present financial situation and make more sense of the accounting. As ratio analysis helps a company's operation by providing useful insight, there are several limitations and problems that will arise. Here are the problems that mostly arise while doing the ratio analysis. One of the problems that will arise is the analysis data originate from actual previous result that the business has made public. Ratio analysis measurement generally may not always predict future business performance. For example, if a company recently acquired another business, historical ratio may not reflect the impact of this significant change. Other than that, financial statements are provided on a regular basis with periods of time separating between each update. The financial accounts do not represent real value if inflation has taken place in between periods. As a result, until the data is modified for inflation, they cannot be compared across different time periods. For example, in time of high inflation, the purchasing power of a company's reported earnings may be overstated.